Did it work?
Hey, it works.
Hey, everybody. Happy Tuesday, and welcome back to another episode of Live with Brian and Brian. I see Raphael, Klaus, Nicholas, Tom.
Colorado, Calgary, Arizona, Manchester,
Awesome.
Spain. Good luck in the game.
Good luck in the game today. It's happening in just a few hours.
Argentina, good luck in the game.
Awesome.
France,
Awesome.
Good luck in the game.
Love seeing people from all over the world. Well, we are trying something new today, and we would love your feedback on it. Rather than just researching a single stock from scratch, we're going to be researching 2 stocks from scratch that we've done previously, and we're going to be trying to figure out which of the stocks is the better buy right now. Mr. Stoffel, what stocks are we talking about today?
So we are talking about Microsoft, 2 stocks that everyone knows, Microsoft and Nvidia. So we would love to know if people own that stock, either one of those stocks.
Let us know in the chat if you are a shareholder of either. So that's what we're going to be talking about today. And we have a little twist that we're going to be going for. So if you've seen this series before, we basically walked through 7 distinct stages. We call them the Simplifier 7 for both of these stocks in order, so we can make sure we understand everything from a fundamental basis about these companies. So yeah, let us know in the chat if you own these stocks. And one thing that we like to start with is just saying, hey, how difficult are these companies to analyze? Yeah. Some are easy, some are medium difficulty, some are hard, and some require a PhD in biology to really understand. I would rate these companies as medium hard, kind of.
I'm closer to medium, but part of it's I think Nvidia is harder, although there's a lot of moving pieces with Microsoft, so that changes it. But I'm in between medium and hard.
Yep, there you go. All right, so let's get into it. And we actually have a fun treat for everybody. So we've been working on a massive upgrade to Stock Simplifier in the background. And we actually have internally a huge database of requests that people have given us for ways that we could improve Stock Simplifier. And after reading through these, we're trying to get as many of them in one go as we possibly can. So we're going to be showing off a beta version that we have internally to use Stock Simplifier, so we can show you the new features that are coming. These features are not yet available, but they will be available to all paid members before the end of this month. So they're just a week or so away from being available. So keep that in mind, because there's going to be some huge changes that we're about to show you to Stock Simplifier, and hopefully you like that we've done here. So for example, we now have a sidebar that makes navigation way easier to get in. And we have a cool simplify look here where you can actually say, show me cybersecurity stocks, super investor stocks, fintechs, defense. But we are starting with Microsoft. So let's go ahead, and
it's worth pointing out as we go through this might be a little bit buggy because this is the beta version. If you sign up today, if you're already signed up, you don't have access to this yet. So we're working it out, but we want feedback.
We are going to be, this might be buggy. We don't think there's going to be bugs, but we need that's why we need 2 weeks basically to push this live so that we can iron out all the bugs we had at the time. So as you can see, we have now unlocked each of the tabs, Stoffel. So one of the things we got to request,
like my favorite thing.
I want to be able to click right to the management page, or right to the phase page, or right to the valuation page, or whatever. So now it's unlocked, and you can go in any order that you want. So right here, we have a nice summary page where we can see a nice chart of Microsoft. So it's actually underperformed over the last 5 years. And I should be able to make that full screen. Yeah. So 5 years is actually underperformed. And we have a new view, so you can actually see the drawdown percent. So Microsoft 30%. Is in a 30% drawdown.
You make a deal with OpenAI that people don't seem to like anymore. They've turned sour on. This is what happens.
Yep. And we have a cool little statistics page right here, so you can see the profits of the company, the overall cash and debt of the company, the growth rates of the company. So this is a mid-teen grower, quick valuation stats, shareholder return stats, and more. But let's go ahead. Yep, this is the right company. I'll zoom in a little bit just so you can see that a little better. Is that better?
Yep.
All right. I think most people know Microsoft. So Microsoft has 3 divisions. productivity and business processes, which is Microsoft 365, LinkedIn, and Dynamics. It's got the intelligent cloud, which is the real powerhouse behind growth, specifically Azure, server products, and GitHub. And then they have the personal computing division, which is like Windows, Xbox, Microsoft Surface, Bing, and more. So the business runs on subscription and cloud consumption. Companies pay for a monthly seat, pay by usage for Azure, and commit to multi-year contracts that lock in future revenue. And once identified, email files and stuff, you become in Microsoft's ecosystem. And we all know who their customers are, right? Everyday consumers as well as enterprise businesses.
Yeah.
New view here, so you can see where the company operates. I'm particularly proud of this one. So 51% of sales come from the US, 45% rest of world. So this company is fairly balanced on where it gets its revenue percentage from. The largest segment is server products and cloud services, Microsoft 365, but this is a diversified revenue business from that. Business quality perspective, is revenue predictable? Sure is. Can it raise prices? Sure can.
Yes.
Is it recession proof? And is their competitive position dominant? I would be hard pressed to find somebody that doesn't rate this business 5 out of 5. Excellent all the way around. Next is the phase analysis here. So phase is phase 4. This one's pretty easy, Stoffel, right?
Yeah, they've been offering buybacks and dividends for as long as you can remember. So
buybacks and dividends. So this is a company that's clearly in phase 4 of the business growth cycle. Moat category.
Okay, now we're talking here.
Yep. So this says wide moat built from 4 reinforcing layers, hard to imagine being breached for the next decade. Switching costs, low cost production, brand and network effects. Identity anchors. The ID is the login backbone behind a lot of enterprises for sure. And the smaller rivals really can't match their scale. Slack and Zoom are competitors, but they don't have the breadth of products that Microsoft does. Let's talk about this. Do you think the moat is widening?
That's the one that I'm not sure I agree with, but maybe I can be convinced. Maybe Stock Simplifier can change my mind.
Margins are expanding. The backlog doubled, although I do know a whole bunch of that is related to OpenAI. And the company is spending massively on CapEx. So if you think about smaller rivals, they cannot come close to the company's budget on CapEx. Only Amazon, Google, Meta can match that. So I think that's why it's saying that. But switching costs, I think we both agree that's there.
Whether or not they're widening, I think it's hard to imagine them getting any wider. But yes, they're significant.
Okay, does scale help customers? Well, LinkedIn has a network effect. Their other products used to have a network effect. Well, maybe Teams does.
Like in-house network effects, not outside of your organization.
So you'd say weak, like sort of there?
Yeah, I would say narrow. I don't know if I'd say widening. I'd probably just say stable.
Okay. IP for sure. Is there a cost advantage? They have massive scale. Can incumbents copy this? I would probably say easily, but I'm going to go wide and growing.
I think that's fair.
Okay, let's go with that. Next tab here, I'm going to zoom out one. Growth. Revenue grew 12% over the last 3 years to 282 billion, and then accelerated 18% in Q3 as Azure ran at 40% growth and Copilot reached 20 million paid seats.
That's the big thing right there.
Cloud is the engine. Accelerating revenue growth is very exciting. They have per seat price extensions. So customers run 50,000 plus Copilot seats.
There's serious lock in there too. Like that's where those. So I actually do believe switching costs are widening.
Okay, good. So we had the right one there. All right, this is a company that's going again mid-teens. Very impressive for a company this scale. Earnings are growing at the same pace. We'll talk about free cash flow in a little bit, but the company definitely has tailwind behind it and a history of buying or building new products, with Azure being probably the best example of that. But if I was to rate this, I think this is about right. I would say good, not phenomenal, not terrible.
I might say slight, like if we had a 3.5, I might give him a 3.5, but it's somewhere between a 3 and a 4.
All right. You want to be generous or not?
Let's do 3. Let's do 3. And I'm saying 3 because I'm keeping our next competitor.
Yeah, me too. All right. Management team here. Bill Gates is no longer involved with the company. He left in 2020, and he owns much more stock than that. I'm guessing, but because he gave a whole bunch of it to the Gates Foundation, Bill and Melinda Gates Foundation. Satya Nadella has been all-star CEO. I mean, very hard to think of somebody that's done a better job. He's 10x the market cap, 3 big deals, 8 straight earnings per share beats. And by the way, we have this new tab here, execution, that shows you their earnings.
Those are significant. Yeah. And now, how much the life of their servers do play a big role in those beats, because
fair enough.
That's the depreciation and amortization charges.
Yeah, fair enough. But good employee ratings, you know, four stars out of 5 on public rating places, consistently beat expectations, buying back stock, returning capital to shareholders, and great financial results. I don't know how you don't give this a 5 out of 5.
It's got to be a 5.
Yeah,
for a company at this scale. I mean, geez.
All right, execution risk, and I'm going fairly quick because I want to spend most of the time on the valuation here. Wide moat, AAA balance sheet, tons of cash flow, fortress balance sheet, diversified, right? Revenues are diversified. Disruption, some risk. Yeah, that's fair. But they have an agreement with OpenAI, who seems to have lost.
Well, they lost exclusivity. So
they lost exclusivity.
I don't even know if that matters, but
they are throwing the money behind this, right? To maintain or at least catch up. I mean, Microsoft is definitely not a leader in AI, but they have the financial firepower to partner with whoever is the leader and kind of make that going. They did toss their early chips behind OpenAI, but I do know that they have multi-model, that they're going multi-model in the future. How much is outside of their control? Yeah, the government saying, knock, 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 you're a monopoly. That's always an ever-present risk, but they have really strong financials. So stock Simplifier says very low.
I wouldn't go that far.
I'll go low.
Yeah.
I think it's a pretty darn low risk business, but the AI threat cannot be overlooked. It's an opportunity and a threat at the same time. Okay. Valuation. This is where I want to spend the most time. So if you notice here, we have some brand new tools for valuing a company. And if you're just joining us, this is a beta version that we have internally for Stock Simplifier. This version you're seeing will be public before the end of the month. So if you're already a premium subscriber, we will be pushing this to you before the end of the month here. We're just working out the bugs. So multiple analysis here. Stock Simplifier suggests price to earnings ratio because it's a mature business. That seems reasonable to me.
Seems totally reasonable.
All right, so let's do it over 10 years. You can see that we added in a price here. So Stock Simplifier basically says anything below $460 per share on a PE basis is cheap, currently 23 times. If we do a 3-year, over the last 3 years, it's certainly cheap on that basis. We also can look at yields. I actually like to look at shareholder yield for a company like this.
You want to explain what that is real quick?
Shareholder yield is buyback yield, which everybody knows, plus dividend yield, which everybody knows, plus buyback yield. And it kind of combines those two together. So this is total capital return on a yield basis. It's going to be higher than dividend yield. So dividend yield is about 0.93%. But if you do shareholder yield, you incorporate buybacks, which are a big part of capital returns. So about a 2% shareholder yield. This is going to fluctuate. And if you know the story here, they're spending hugely on AI infrastructure, right? So less capital available for buybacks. So it doesn't surprise me that's a little bit down. But probably price to earnings is the best multiple to look at.
I like what Dennis said. What about forward multiples? Can we look at that real quick?
Yeah. So we do not have forward multiples yet. That is also coming soon. But if we go over to fiscal, we should be able to get forward multiples. So ratios. And let's take a look at the forward multiples, forward PE. So 21 times forward earnings, 21 times forward earnings. And again, if we add so this company usually trades at about 29 times, or at least, the average over the last 10 years. Maybe let's shrink that down to 3. Yeah.
I mean,
so straight
away, you're talking about a company that's significantly more than 30% undervalued based on the median.
Yep. 21 times forward earnings, 21 times forward earnings, and earnings might be the best choice here for the company. But one thing that we built into Stock Simplifier that we are really pumped about is a reverse discounted cash flow calculator. And I built this with Stoffel's basically criteria in mind. This looks like slightly complicated, but we'll break it down one piece at a time. So we can change the assumption. So 10 years?
10 years sounds good.
Yep. Now we actually say, do you want to do a single growth rate, or you can actually split it up into two separate growth rates?
So let's do a split, because I went and I looked at what the estimates are. We'll do a split. And what we're going to optimize this, correct?
Okay.
So,
yeah, we can.
So because we're optimizing the cash flow margins, which we'll do in 1 second, revenue is supposed to grow about 17% per year over the next 3 years. So let's pull that yellow box to 17%.
Okay.
And then I would also say that for the terminal growth rate, this is a company that has a moat. And when a company has a moat, which we've determined, they have pricing power. So I feel comfortable giving them a 3% terminal growth rate.
Okay.
And then the discount rate, I just like leaving it 10. I like doing that for almost all the stocks I do.
All right. So just so people understand, we're putting in the revenue growth rate over the next 3 years at 17%. And you can actually check their history right there, so you can see how fast they've actually grown. So we're assuming over the next 3 years, 17% growth, which is what analysts are estimating. And then we're going to optimize the margin. So right now the free cash flow margin is 23%. I have a feeling that's going to be low. It is.
Yes.
This is a company that over the last 5 years has averaged 30% free cash flow margins.
And so what you got to do here is you got to say, okay, AI build out. Like I've said this on many, many occasions. Drive down the freeway from where I live and you see a 2-mile long building being built that's a data center. We heard about Facebook Meta building one that's 5x the capacity in Louisiana. But these aren't going to last forever, okay? But it is probably going to be a permanent maintenance drag. So free cash flow margins used to be 33, 34%. I think if we're optimizing over 10 years, optimizing at 30%. So higher than today, but lower than where it's been in the past. And so the beauty of this then is it tells us, well, okay, if Microsoft really does have 30% optimized free cash flow margins, that's an if. That's a guess we're putting in. And if they have 17% revenue growth over the next 3 years, that's what analysts expect. Well, then in years 4 through 10, if they hit those margins, then revenue needs to grow about 10% per year to be market matching. From where I'm sitting, I know where that lands for me. Maybe if we're going to have the audience vote on one thing, Brian, what do you think? Should we vote on this?
For sure. But yeah, like let's visually break this down. So what this model is assuming is 17% growth over the next 3 years. And what we're solving for is what are the growth rates in years 4 through 10 with a 3% terminal growth rate. So the company has to grow revenue, not free cash flow, revenue at a 10% growth rate in years 4 through 10 after growing 17% per year. And the question we have to ask is that reasonable? Is that low? Is that high? Basically, do you think all the spending that's going into AI is going to pay off in any way?
Yep. And Dennis brings up a great point. This is why we're showing the calculator, but if you want to use it, sign up by the end of the month. This will be pushed out to everybody. You can figure out, well, how does changing that to 25% instead of 30% change things? The answer is then they got to grow up 14% per year. There you go.
Yep. So we give you all the tools that you need. Let's just do a single growth rate so you can just see, right, what is the growth rate at if they can get to a 30% margin. They need to grow 12%, 12.6% compound annual growth rate revenue over the next 10 years to justify today's price. How about 20 years? It has to grow 9% per year revenue at a 30% free cash flow margin to justify today's price. So this is a really cool tool that we've built. We can't wait till you guys get your hands on it.
But let's give us a rating, like 1, very expensive, all the way to 5. We've had some people putting in what they think just verbally, saying it's pretty reasonable,
what do you
conservative.
1 through 5, how would you guys rate Microsoft's valuation today?
Yeah. I'd be very curious about this. I have a pretty good idea of where I'd land in this.
Yep. And as a side note, so just so you know where you got that from, if you go to fiscal, revenue again is expected to grow about 17% over at least the next 2 years. Earnings, for what it's worth, is expected to grow about 16% over the next over the long term. So over the next 5 years.
Basically all 4s and 5s. I would land at a 4 myself.
All right. Okay. So here is the summary for what we got. So the business is a 5 out of 5. It's in the capital return phase. The moat is 5. Moat direction is 4. Growth is average. Management is great. Risk is low. And the valuation is attractive. Now we now have Stock Simplifier give you things to look at, red and green. And if you want to change these, you are free to welcome to, watch Copilot revenue or Azure, whatever. So you can now, it gives you suggestions about what to track to make sure the thesis is on track over time. And you can now put it on one of 5 watch lists. Previously, we just had 3. So let's call this a buy. Here's what I love, Stoffel. After you do that analysis, we give you some options. First off, you just want a 1-page summary of everything that we just talked about. You will be able to download a 1-page summary of visually everything that you just recorded. This has been a big request of our members, and I think that this came out beautifully to be able to.
Him and Susanna love it.
Yep. The second thing you can do, you can set a price alert. So if you don't love the stock price today, you can say, hey, when this thing gets 10% cheaper or 5% cheaper, give me an alert. Now we have an alert thing up here that will notify you of any alerts are tripped. It's just in app right now, but we hope to push this to email down the road. That's going to be a pretty big build, but now it's much more interactive after you're done so that you can get a summary of it or set an alert or those kind of things. And then finally, you can, of course, go to your dashboard and see it, but we actually have this new section called Capital Return, and you can get a full breakdown of the company's dividend policy. You get a safety score of the dividend. You get some metrics on it. You can see how the dividend has evolved over time. And we also have a buyback section, so you can analyze the company's buybacks. Are they?
I love that includes a stock-based comp too.
How much are they buying back stock? How does that compare to stock-based compensation? So we've put a lot of effort into making it so after you're done with the evaluation, there's cool tools that you have to do even in more depth analysis than you did previously. And if you're just joining us, I'm showing you a beta version. This will be available to all paid members before the end of the month. So we're showing it off now to just get feedback from people, but it's not yet available. But if you're a premium member, this will be available to you before the end of the month. So we hope you like the changes that are coming. All right, good. Looks like a lot of people are.
I think that people have spoken. They think it's pretty neat.
Yep. So we've unlocked it. We've added a financial tab now, so you can check out the financials of the company. We're building out a full earnings section here, so you'll be able to check revenue and earnings versus estimates. We want this to be a tool that you guys use to track a company basically every way, at any way that you want. So a lot of. Thank you for the feedback that we've gotten from everybody so far that's in a user, because we've been compiling it, paying attention, and we basically had to rebuild the app to accommodate everything. So hopefully you guys.
Ari says you're doing a great job, Feraldi. You and Justin. Stock Simplifier up and to the right.
There you go. By the way, if you want to get this today, not the one you're seeing, Stoffel, go ahead and share the link. We do have the ability to do a free trial with the current version of Stock Simplifier. And if you do become a premium member, once this is available, it would just be pushed out to everybody, and you'll get access to exactly this new view. And everything that's coming, that everything that you're seeing on the screen is going to be coming before the end of the month. Great. Awesome. So if you could share that link. All right. Moving on to Nvidia here. Well, we could get to that so many different ways. By the way, we built in a really cool discovery engine here so that you can discover stocks and you'll be able to search for them. This is unlike any other screener that is on the market today, because we allow you to screen by things like capital types or how difficult the company is to analyze. We actually built a wizard that lets you search for the phase that a company is in. So many cool features are coming based on requests that we've gotten from people. But let's go ahead, and now we're doing Nvidia. All right, Nvidia.
So let's just get this over from the outset. one is a cyclical company. That's
Yep.
Nvidia, or at least historically has been a cyclical company. One is not, because subscriptions are what drive everything. That's going to be an important distinction here.
Huge distinction between the two. And that's an important thing to keep in mind when we do the valuation analysis. But if we just look over the last 5 years, market smasher, market smasher. And is this company down from its high? Let's see. Sure. It's down 11%. Microsoft was down 30%. This stock is down 11%. If you look at the growth, I mean, the growth here is off the charts.
Look at the 3 years doubling every year.
The margins are even better. This is a company with a 45% free cash flow margin, tons of cash, basically no debt, slightly more expensive and slightly smaller capital return. But let's go ahead and analyze this. Nvidia designs chips, networking gear, and software that the world's largest company used to build AI systems. Think of them as the picks and shovel supplier to the AI build out, selling out not just GPUs, but full rack computer systems. And they run models like ChatGPT and Gemini. The business has changed fundamentally in the last 4 years. CUDA, which is a must-know term if you're an NVIDIA investor. This is the software stack that NVIDIA has been working for 20 years, and it's become the default substrate for AI training. This has been a massive advantage for NVIDIA. They sell silicon networking software together, which is why margins are so high, even with the most complex chip packages in the world. 90%, 91% of sales are now data center, Stoffel.
Mm-hmm.
Cool visual here.
Used to be a gaming and crypto company.
Yep. So the large hyperscalers are their customers, including Microsoft, the neo cloud providers, sovereign AI programs, and enterprise and gamers. Quality time. So does it have predictable revenue?
Usually no.
Yes, usually no.
But when everything's sold out, it's different.
Yep. Yeah, it's become much more predictable. Can it raise prices? Easily. It says easily. And margins have been skyrocketing in the last couple of years. Is it recession proof? Well, previously it was definitely not recession proof, but it's become, thanks to the AI supercycle and competitive position, dominant. I don't think there's anybody that's going to push back against giving this a 5 out of 5 company rating.
Shouldn't be any pushback. I mean, this is not your typical phase 4 company in so much as you don't normally see a phase 4 company growing above 50% per year. This is a weird one, but given the dividend and the buybacks, you got to say phase 4.
Yep. So let's just say phase 4. Moat. Now let's get into Moat. All right. This
is everything.
5 out of 5 Moat historically, driven a huge way because of CUDA. CUDA software program is the default factor. 5.9 million developers. Jensen Huang was absolutely brilliant for investing in this years ago. And every number they have basically screams wide moat today. I don't know how you would even debate that.
Yeah, it's not really about where the moat is today, because I don't think anyone in their right mind would argue that it's wide. It's about the direction. And, you know, like Tim brings up a good point. Like Amazon and Google are building their own chips.
Yep.
Is that a threat? Like, that's the real question.
Sure is. Yep. So it says the white moat is widening, but that's based on margins, developer counts, and customer breadth. Margins scream widening, or at least pricing power, right? I mean, margins have gone crazy. Return on invested capital.
But I will say the margins, as good as the margins are for NVIDIA, like the memory chips are even higher. They're in the mid 80s.
I have more confidence in NVIDIA's long-term pricing power than those, but maybe
that's talk about that for just 1 second.
Well, that might just be my history with looking about the memory companies. Memory seems to be slightly more commoditized than do the chips themselves, and the software that NVIDIA has built in with CUDA makes its revenue, at least to me from the outside, seem more durable in nature. Like the memory chip companies are phenomenally profitable right now, but that seems just like the supply imbalance. But both of them have done phenomenally well, and I'm not going to knock the memory chip companies in any way. But if you force me to say which one do I think is more durable, I would say NVIDIA.
Sure.
Okay. Broadening customer base. So How hard is it to switch? Very hard to switch because of the software.
Yep.
Very hard.
And once you build these into your systems, you got to pull everything out and put in new ones if you don't.
Yep, for sure. Does scale help? In other words, is there a network effect to this? The CUDA definitely has a flywheel with developers. It says somewhat. I would agree with that. It's not impenetrable, but it is there. Great brand name, great cost advantage, and Nvidia can incumbents copy? I would probably say yes. I mean, the business model doesn't seem to be uncopyable. So I'm personally would say wide, and then
that's exactly what I would say too. I would not go 5 and 5, but I would go 5 and 4.
Growth analysis. Revenue has compounded 68% for 4 years. Revenue was up 85% in 2026. Operating profit grew even faster. Free cash flow grew even faster. And the supply, this company is supply constrained, not opportunity constrained.
And that's a big deal too, because of their relationship with Taiwan Semi, they are going to be able to increase their capacity first before everybody else.
Yep, for sure. Now let's go over to fiscal. Pull them up in fiscal. And if we look out, so what's the growth rate? What's the growth rate over the next 2 years?
3 years.
Oh my God.
So go down. It should give the growth rate if you go down, if you want to see the actual number there.
82% and then 41% is the estimated growth rate for next year and the year after that. That is unbelievable that their growth rate is accelerating.
Well, and not only that, but go to the estimates and you can see that there's reason to believe it will actually be closer to like 90%.
Look at this.
50%.
Yeah. The estimates are just rapidly increasing. You want to see lines that are trending upward. That means not only are their estimates growing, but the estimates themselves are still conservative. And this is a company that beats on revenue. So this is a company that's expected to grow revenue 60% over the next 2 years. And over the long term, so 5 years, earnings are expected to grow 39%. 39%.
It's pretty good.
Just insane. Again, I don't know how anyone would push back against. Does it have high growth potential? It sure does. It sure does. Management time. Jensen Huang has been running this company for 33 years. He pivoted it from a graphics company to an AI company. Revenue has gone like crazy. I mean, how many CEOs / founders have a tattoo on their body of the company they founded? I can think of exactly one, and it's this guy.
Yeah.
So even better employee reviews than Microsoft. Like excellent execution, shareholder friendliness. The only thing you can knock them against is they buy back stock at really high valuations, but that's like what do we do with all this cash that's coming in? And then they just had one miss in the last 8 quarters from an execution perspective, but 5 out of 5 all the way.
Oh yeah.
Not even going to debate that one. Risk. This one might take some time to think about. All right. Fortress balance sheet sits over 3 real external exposures. Hyperscaler concentration. So this is a company with customer concentration issues. US-China export controls. That's not something Microsoft had. And the Taiwan supply. I would say all of that is completely fair. Yep. Customer concentration is intensifying. One customer was 22% of revenue last year. Who would you guess that is?
I mean, my best guess would be Microsoft.
Yeah, or Google.
Maybe, but Google and Amazon are making their own chips, so it just makes me believe that maybe those would be lower, but I don't know.
It's still one customer is 22% of revenue, right? 4 customers are over 10%, combined for about 61%. So 61% of this company's revenue comes from those 4 hyperscalers, 61%. So losing any one of them would significantly dent this company's growth rate. Then there's geopolitical risk, the U.S. export controls. That is like a on-off thing. I think it's on right now, which is probably what it should be. But they also have big concentration through Taiwan Semi in Taiwan. Balance sheet is phenomenal. But concentrated revenue streams, disruption. Yeah, we need to talk about disruption, right? This is Google.
Yeah, so those ASICs, so Google, so this is where Broadcom has become a $1 trillion company of making custom chips for other companies. And Amazon has talked about how they've got, I think they said a 20 to $50 billion run rate business if they were to just sell those chips.
Yep.
The thing is there's still so many areas that Nvidia can fill in. Like they're getting into CPUs and robotics and yeah.
So you're saying the growth avenues ahead of this company could overwhelm any short-term loss of a customer or even customers insourcing. Or I know one thing that Elon has said at Tesla forever is basically like, when it came to the batteries, they're like, the demand for batteries is so big. We're going to buy every battery we possibly can externally, and we have to manufacture them internally. Like that might be the scenario here where it's like the demand for GPUs are so high that we will buy as many as we can from Nvidia, and we have to manage our own internally.
The thing is, and it's not just GPUs. They're getting into CPUs. They're getting into the full stack that's necessary. So that's the other part. Like that's not something that Broadcom is working on for Google or other customers.
Sure. But either way, customer concentration, absolutely. Geopolitical risk, absolutely. And customer disruption risk, I guess you'll call it. Stock Simplifier says moderate for riskiness. What are your thoughts on that?
I would actually probably go high just because, but more because of the history of the company than anything else. And by that, I don't mean anything NVIDIA has ever done wrong. I mean cyclicality. I mean, you could get this right. It's not about when supply and demand start to meet or the gross margins go down. It's about when the market starts to sniff the possibility of that.
Sure. And you have long harped on, your previous checklist that you had basically one risk component, and it was concentration risk.
Yep.
And this company has concentration risk. So I think
not its fault, but it just does.
Yeah. But it's a reality, right? I think high is probably appropriate there. If you want to go moderate individually, that's fine. We're gonna go high. All right, valuation time. So this is a mature business. It is optimized for profits. So PE ratio makes sense. On a trailing basis, this company's PE ratio is 32 over the last 5 years.
Now remember, it's supposed to grow 82% this fiscal
82%. Next year. Now let's start by looking at its forward price to earnings ratio, because that's a good place as any to start. I'll close that. And if we go ratios, and then we go to forward, and we go to PE, 21 times. That's like exactly the same as Microsoft.
Yep. And so the difference is Microsoft is a non-cyclical company growing at about 17%. Yep. Nvidia is a cyclical, traditionally company growing at 82. I'm going to guess 90% this fiscal year.
Okay. Yeah. So that is the market's way of valuing these companies similarly on a forward basis, despite one growing way faster. I think that's the market saying the riskiness of the growth of this business is higher than it is for Microsoft.
Yes. And I agree with that. I think that's true. And we gave it a higher risk rating than we gave Microsoft.
Yep. I bet if we look on a price to free cash flow basis, that actually makes sense for this business. So this is saying the company is cheap anywhere below 260. But again, this is trailing numbers. Let's do a reverse DCF on this. And this is probably pretty good because the company is so optimized for free cash flow right now.
Yeah. And I'll tell you what. So I'm actually going to have you lower the optimized free cash flow, which is, that's not usually what we do, but I'm going to have you lower it to 35%. So that is more in line with like, so to be clear about what I'm doing here, I'm saying that they will lose some pricing power, right? I think that's being conservative. Pull those free cash flow margins down. I will give them a 3% terminal growth rate because I do believe that they have enough of a moat that they have some pricing power. Okay, so we lowered it, and then we have to do this split growth. Okay. So Brian, I looked out over the next 3 years. Now you might not believe this, but over the next 3 years, they are expected to grow at a 50% annualized rate. 50%. So
and the estimates have been going up.
And the estimates have been going up. I did nudge it up. Technically, it's 48%. I nudged it up to 50.
Yep. So over the last 3 years, they've grown 194. Over the last 5, they've grown 83. But this is what they're projected to do over the next 3 years. Is essentially
revenue.
Yep. Revenue. Yep. 3 years is revenue growth. Okay. So 3-year revenue growth rate of 50%. And what we are solving for is how fast they have to grow in years 4 through 10. So 9%.
And remember, we pulled those margins down by a lot. They were at what, 49%? And we pulled them all the way down to 47, down to 35. So we are.
I'm curious if we kept the margin the same.
Then it would only need to grow 3%.
Yeah. So if you believe that the company can grow 50% annualized over the next 3 years, which is what it's currently estimated to do, and you believe that margins are sustainable at the crazy high rate. And to be honest, if a company can grow, if you buy that as a growth assumption, why on earth would margins fall?
Right. No, I get it. I get it. But I'm just being conservative. This is why we give you the tools so you can put in the numbers. This is my way of being conservative.
All right. So you're assuming a 12% drop in free cash flow margin, which is quite big. Given where it is, you're assuming 3-year growth of 50% compound annual growth rate, which is essentially what it's expected to do. And that means the company needs to grow 9% revenue in years 4 through 10. So here's what that looks like.
Can we do one quick thing? Can you go up? Because Brad's asking, what does split growth mean? Can you just do single rate real quick?
Yep.
So if you do single rate, what this means is over the next 10 years, Nvidia needs to grow average 21.4% revenue per year for 10 years. Okay.
At a 35% margin.
At a 35% lower than it is. Yes. However, with a company that is secular growth like Microsoft that doesn't have that cyclicality, that's what we would use. However, this is a cyclical company. So we do the split growth. And when we do the split growth, what we're saying is we believe that it'll grow about 50% per year for the next 3 years. If it does that, well, then from year 4 through 10, it just needs 9% growth.
Yeah. This is kind of like a hybrid between a DCF over the next 3 years and then a reverse DCF in years 4 through 10. So it's a reverse DCF with a slight twist to it where you're inputting growth rates over the next couple of years. But if you just want to do a flat reverse DCF, so if you hold everything steady, if we made no assumptions about anything's going to change except for the knowns that we have, this company has to grow 17% over the next 10 years to justify today's price. And then this is what that would look like from a free cash flow perspective. That's still $500 billion in free cash flow 10 years from now. $500 billion.
What do people think? 1 through 5. What do you think about the
What do you think of Nvidia's valuation today? So the forward PE ratio said 21 times, right? The trailing PE ratio said cheap. It's definitely cheap on a trailing basis. On a forward basis, it also looked below its recent average. And then this is what it's estimating for the forward numbers. Excuse me, for the reverse DCF.
What's interesting? So what we're getting is a lot of the same, which are 4s. I would tend to agree with that. I would give it a 4. But Brian, just for interest's sake, if we go all the way back to 2005, the median, and I say median because absurdly high growth rates don't skew this that much. The median growth rate for Nvidia for the last 20 years has been 19%. 19%. If it hits those numbers, we're saying it just needs to be 9%. There
you go. Bill asked a really good question here. Bill said, is this free cash flow we're talking about or revenue we're talking about? You are correct. So if you do a single rate and you assume and you don't optimize the margin, free cash flow needs to grow at 17%. We've programmed this so the second you adjust the margin,
look at that, it changed.
The second you adjust and you change the free cash flow margin being assumed, then the tool automatically switches to revenue growth.
Because it knows that you're trying to optimize it in some way, shape, or form.
You're changing the free cash flow number that goes into the model. So you're switching from the assumption being about free cash flow growth to revenue growth. But that's a great question.
Yep.
Yeah. But either way, people are saying
yep, 4. I mean,
4 out of 5.
Almost uniformly.
So to review, we get a composite score of 4.3. This is a 5 out of 5 business with a 5 out of 5 moat, a 4 moat direction, great growth, great management, a higher risk number, to higher risk, and a 4 out of 5 valuation. So let's compare that to Microsoft. If we go to watch, so Microsoft was a 4.3. Is that exactly what it was? So yep. With Microsoft, I would argue you get slower growth, but
lower risk.
But lower risk and more predictable growth. With Nvidia, oops, wrong one. You get much higher growth. And the reason the market, at least to me, is not valuing that growth at the same rate that it would be a Microsoft is because it also thinks that growth is higher risk and has a higher volatility to it. So there you go. So at a broad level, if you want a lower risk, lower growth investment, Microsoft seems like the better choice. If you want a higher risk, higher upside potential investment, Nvidia seems
it's funny
like
to say higher upside about a $5 trillion.
I know that is bananas to think about, but that's what we are doing this. Either way, I think this belongs on a buy list. And again, we have this cool feature. Look at this. I just love the way that this one pager comes out. So these are all of the numbers that we put in there at the top. We have all the numbers down below, and it's a nice one-page summary of everything that we just did. So this tool unlocks after you've simplified a stock. So this isn't available until you have gone through the process and simplified it. So I am super pumped about that to get into again to people's hands. And if you are just joining us and you're a Stock Simplifier user already, this is not yet available. This will be available before the end of the month. If you're a premium user, we will just give it to you as soon as it's ready. I will send you a notification about this being available. But as you've seen, we've made some massive changes to the look and feel of Stock Simplifier. So we want to make sure that we get the bugs and all that kind of stuff worked out. But it was in a good enough phase where we could start to show it off and start to show you what we have planning. And again, we have all the financials of the company in here, the income statement, the balance sheet, the cash flow statement. You can do ratio analysis, key metric analysis. All of these charts are now graphable. They are downloadable. They are shareable. So we have some really, really cool things that you can do right on here. You can analyze the capital returns of the company. You can see, is the company's dividend safe? I mean, yeah, quite safe. You can analyze the buybacks. Look at the buybacks versus stock-based compensation. But even
that's
still,
$100 billion in buybacks over the last 4 years.
And the share count is declining by about 2%, per year. And we're going to be building out this earnings tab so that it has not only earnings estimate, but revenue versus estimates on there, which is the same thing to me. So all of this is coming soon. We can't wait to get it in your hands. And if you could share the link so that people can start a free trial of the version that exists today, you can definitely get started today with Stock Simplifier, and you'll be the first one to get this update when it is available sometime before the end of the month.
Yep. Tool that I now use. It's almost exclusively the tool that I use.
Excellent.
That was your goal, right? To make my life easier.
Yeah, absolutely. So Robert, who has access to this? Just me and Stoffel and the internal team. We're working out all the bugs. And as soon as all the bugs are worked out, we're going to push it live to everybody that's a pro user. But it was in a good enough space that we could start to show it off. And we want to start training people how to click and everything like that so that it's coming.
We should show our friend Justin that everybody's telling him to get. Justin's the one who does all the hard stuff for us.
All right. But with that, we did promise people better buy Nvidia or Microsoft. Stoffel, you go first. Which one do you think is the better buy?
Well, I gotta go with where my own portfolio is, and that is Nvidia. I own Nvidia. I do not own Microsoft. So Nvidia, and I'll say this. Look, if I was 60, closer to retirement, Microsoft would probably look more appealing today. However, I still got 20 years until I hit this date right here. So I like Nvidia. I'm willing to take on more risk for more reward.
Yep. Personally, my choice is Microsoft.
There you go.
Type of investor that I am, I value durable, higher quality growth than I do exciting, more shorter term growth. Both of these companies I would happily have in my portfolio. Two of the best businesses on earth. But I personally would rather accept a higher likelihood 15% than a lower likelihood 20 or 25%. That's my investing style and the stage of investing that I am. So I personally think that Microsoft is the better buy right now, although it's hard to go wrong with either.
I think both are correct. Hey, just real quick, Brian, because I want you to make Richard stay here. How much is the subscription cost going to go up with this new version?
Everybody that has a current premium subscription to Stock Simplifier is going to get it.
So
it's going to be included. It's going to be included in your subscription. Nothing about that has changes. That is one reason why we went with going with a software tool, and it has a subscription to it. So as we continue to find ways to make it better, everybody that is a user just gets access to the most recent version as soon as it's available. So if you're already a Stock Simplifier premium user, this is going to be included for free. It's going to be included with your subscription.
Yep.
So yeah, this is a big reason why we changed to the model we did of having it at stocksimplifier.com versus the one-time download. So again, this is coming before the end of the month. And we have some other upgrades we're working on that will even enhance it from what you've seen today. So we've been very busy over the last couple of months.
Yep.
Cool.
All right. Well, hey, that was really good. Because no matter what, I think people are going to walk away from this and say, okay, both great companies, both pretty good buys right now. If you want lower risk, you go with Microsoft. If you want a higher risk, you go with Nvidia.
Yep. Please actually let us know in the comment section right now. Do you like this format? Do you want us to pit two stocks
battle royales
against each other, or do you want us to mix it up between just doing one stock for an hour or two stocks for an hour, or we could even do multiple stocks and really just focus in on the valuation? We're open. We wanted to try this just to see, hey, what do people think of a little bit of a battle royale format?
Yeah, I'll tell you, we did get a request for a super hard one here. Doing Berkshire Hathaway.
If you just said yes,
that would need to be a 5-hour session.
If you just said yes, I assume that means yes, we like the better buy format. Okay, got it. 2 or 3 stocks. Great. 2 stocks per hour. Great. Yeah. Because then we can keep up with what's happening with them as we go along too. So
let's do it until people get sick of it and they want a different format.
There you go. We could even rank stocks. So we could even say, hey, here's 5. Which one, based on the valuation that we see, is the best, or which one has the best capital return program? So if you have ideas for us, Brian at longtermmindset.co. We are completely open to ideas for this, but we'll keep experimenting. And thank you to everyone that showed up live. So if you're a Stock Simplifier premium user, or you hope to become one, keep an eye on your inbox. Everything we just showed you will be available to you before the end of the month. We are going to be working diligently to make this happen.
Awesome.
Great. Awesome. Well, thank you guys so much for joining us, and we will see you next week. Hope to see you then. Bye, everyone.
Have a great week.